Hello and welcome to the i3 podcast. My name is Wouter Klein and I'm the Director of Content for the Investment Innovation Institute. For more information about our educational forums for institutional investors, please visit our website at www.i3-invest.com. There you can also subscribe to our complimentary newsletter i3 Insights, in which we discuss investment strategy and asset allocation questions with asset owners around the world. Now, as you all know, we love our disclaimers in this industry, so here's ours. This recording is for educational purposes only. It does not constitute financial advice. Please enjoy the show. Well, I'm here today with Greg Cooper. Greg, welcome to the podcast.
Thanks, Walter.
So can you tell me a little bit about how you started in the asset management industry? We had some former guests on here that started with, creating banks at 8. What were you doing at 8?
I certainly wasn't creating banks, probably more surfing and that kind of stuff up on the beaches on the Central Coast than anything. My career in investment really started in the latter stages of high school. I was at one stage looking at becoming an accountant, and then my maths teacher at the time had said, have you thought about actuarial studies? I didn't even know what one was at that point in time, and so I looked it up, and things kind of sort of went from there. So that, I suppose, that was the real genesis of things, year 11 and 12 at high school.
Yeah. So how do you transition from an actuary training to an investment career?
So, I started out in the more traditional actuarial fields. I was working for Towers Perrin at the time as a defined benefit actuary, and it was at the point in time, it was in the early 90s when the SG was just coming into play. Defined benefit plans, some were being wound down, but there was a lot of work to do in the DB space. But as SG kind of kicked in, then there was a whole pile of actuarial work to do around justifying minimum contribution levels and so forth. And then one day one of the investment guys had come over in the investment asset consulting area, had come over and asked me if I was interested in doing some research, and it was on managed futures at the time. And I kind of said yes, and started doing it, and I really enjoyed it. And that was kind of the first foray into investment consulting. And so sort of from starting out in the actuarial field, I was lucky enough to get offered a role up in Hong Kong with Towers, and I sort of took the view that the traditional actuarial work was a good mainstay, but was not likely to be your growth engine. And moving into the investment space was a lot more interesting, and it also worked from a commercial perspective.
Yeah. Did you end up doing anything with those managed futures research?
Well, apart from, it was kind of the early stages of hedge funds, I guess.
Yes.
And it was at the point where saying, alternatives kind of had a place in a portfolio. That was the primary emphasis of the research. It was interesting. And obviously, alternatives nowadays have become a much bigger part. But back then it was really just looking at that small hedge fund-like type diversifying characteristics and see whether they fitted in a portfolio.
Yeah. And then from there, you went to Schroders and started doing Japanese equities. Why Japanese equities?
Yeah, good question. It was really, partly as a function of the role that was there at the time, and Schroders. I'd come out of asset consulting. I was much more interested in working in the asset management side of things. The role, while it was in Japanese equities, it was much more about the product side of things. So it was more like being in charge of the business of running an asset management sort of sub-strategy, if you like, rather than specifically worrying about, Japanese equities or European equities. But it was very interesting because at that point in time, Schroders was the biggest manager of Japanese equities. You were just coming out of the 90s, which had been a bit of a lost decade. But in the latter part of the 90s, Japan had taken off with the likes of SoftBank and so forth. So, there was this real kind of boom happening, and it was just a really interesting time to be involved in the markets, but particularly in Japan.
Yeah. Any views on Japanese equities today?
Well, it hasn't been a terribly good investment since that time. I remember one day sitting with one of the team, and he said, I started in Japanese equities in 1986, and the market's pretty much at the same level it was then, and I think more or less say the same now. So, but it's it's a very interesting case study in what happens in a deflationary environment, and when assets get overvalued, you can have everyone thinks that equities kind of go in 10 years in equities you'll make your money, but you'll make money.
I was just about to say, did I just hear you say that equities don't go up always?
Yeah, that's right. So and it's a fantastic case study, but also one. I mean, sort of investment aside, it's a good one to think about that. Despite the economic criteria not looking that good, the social cohesion in Japan and everything else is held together very well. And so, life isn't all about just economics. There's more to it than that. Sorry, all the economists. Yeah.
So you spent almost 20 years at Schroders, climbed up to be the CEO of the Australian business and also had a global distribution role. What are some of the highlights you look back on your career, and also do you have any tips for aspiring CEOs?
I suppose in terms of highlights, it was fantastic and still is fantastic being involved in sort of the dynamism that is the whole investment marketplace. I mean, in particular, just look at, not just Australia, look globally, but certainly in Australia, the rate of change that's taken place with funds, and, back in the late 90s, early 2000s, there was obviously a much larger number of very, very small funds. And you look at where we've come to now, and we're having conversations about internalising and, financing specific assets and, the size of the asset pools and so forth. So I would say, over that whole span, it's just been a very exciting time. And I think that will continue. It's no less exciting looking forward than it has been in the past, but just the sheer growth of the industry has been fantastic. In terms of some particular highlights, I always quite enjoyed standing back and looking at sort of the way the industry was developing and coming up with suggestions for maybe how things could be done better, or where the industry had adopted certain practices that I didn't think were the right sorts of practices, and it was much more fun kind of standing back and trying to point those out and offer suggestions for better ways forward, rather than just joining the chorus of salespeople out there.
Can you give an example of that?
Probably, the key one that and I wrote a lot of research papers around this is the concept around sort of objective-based investing, and the idea that benchmarks and the whole strategic asset allocation process, which we'd grown up with in the 80s, didn't always work. And Japan is a great case in point. A fixed strategic asset allocation with a large exposure to equities through the 90s in Japan killed you. And so, that to me is, it's resonated very well in the industry. And I think it's a key part of sort of thinking about how to do things differently. Yeah. And so, it's not to say that strategic asset allocation is that style of investing is bad. It's just to say that I think we've moved on from there, and there are better ways to think about this, and there's some consequences that come from that, and it's worth bearing in mind the consequences.
Yeah. So in your answer, it sort of shows that you've always been quite keen on fostering a culture where it's open for discussion, and there's pretty much no topic of debate. Why is that so important?
To my mind, we work in an industry where there are lots of really intelligent people, and no single person has all the right answers. So the more you can foster debate, and the best way to foster that debate is to have a fairly transparent and open culture, then ultimately you get a better outcome. And it might be sort of painful in the near term to hear, your particular idea shouted down, or what you're doing, doesn't resonate with everyone. But I think fundamentally it gives you much better outcomes. And when people are, more open, transparent, and in particular prepared to bear criticism to their ideas, that's how you drive change and move things forward. So you asked about sort of tips for aspiring sort of CEOs, and that would be a very clear one to me is don't be afraid of what others think, and try and draw out that, and certainly don't create a culture where yours or a small number of views preside. You want to create a culture where you hear right through an organization, and particularly today, like the world's changing so much, sometimes the best ideas come from some of your really junior people who are right at the coalface. So you want to make sure those ideas get aired and have as much resonance as some of the more experienced ones.
Yeah, so is that a matter of staying competitive, or is it also more generating sustainability within a business, that you can see risks or potential challenges coming that are further ahead?
I think it's both. I think this industry is nothing if not cyclical. We see markets are very cyclical. Performance of asset managers is very cyclical. The active industry is probably having a pretty hard time of it at the moment. I see that as a very cyclical outcome, and I just think that if you're not open to sort of change happening, then particularly when times are good, and that's often the time where it's hardest to make changes in an organisation because everything seems to be going well, but that is often and always the most dangerous time when everything's going really well because you tend not to see the risk. So just trying to, and it's not to say you get it right all the time, definitely not, and it's difficult, absolutely, but at least, keep your eyes open.
So one of these big topics we've recently spoken about is the functioning of the public markets, and we see that more companies stay longer private. There seems to be a bit of a challenge in raising capital through the public markets. What is your view on that? I think you have a bit of an idea that maybe the public markets aren't what they used to be.
Yeah, look, I think I wouldn't say the public markets are broken, but I do think there are some real issues in the way public markets are functioning. And if one goes back and sort of says, well, what was the point of a public market? It was to allow, capital to be held in the hands of a very, very heterogeneous group of individuals, and for new capital formation to happen. The way the broader investment market has changed is you've got a smaller number of very large holders, and almost by definition, those holders end up becoming more passive in their equity holdings. They have to become much more active in a governance sense to compensate, but they become much more passive in terms of their equity holding just because they have to be. So I think that has changed the way public markets function and will continue to change them. And at the same time, whether it's regulation or other things, sort of driving how new capital gets formed, people are more prepared to sort of keep their companies private and accept some of these large investors because they just don't need to go to the public markets, and the private markets tend to give them a bit more flexibility. So I think that's changing the whole dynamics of it. Where I see a real danger is in the smaller end of the corporate capital formation process, where how do new ideas get funded? And I think in other jurisdictions, particularly in the US, where they have a really well formed venture capital industry, we don't have that. And I think there's a danger in Australia that not having a well-formed or even you barely call it embryonic VC type industry means that there'll be lots of good ideas that get starved of capital and potentially go offshore. And that's bad in the long term for the economy and bad certainly for those funds in the long term.
So to what degree is this also the influence of quantitative easing? Because you could make the argument that, well, it's easier to raise capital from the private markets when capital is so cheap. But once that goes away, then perhaps the public markets start functioning again the way they should be?
Well, there's certainly more capital around. There's no question of that, just given what's happening in terms of QE. But whether we have QE or not, you will still have larger asset pools. So in a relative sense, you could just have to look at the Australian market. The top 10 asset pools, represent a significant chunk of the Australian equity market. So that feature occurs no matter what, with or without QE. So I think QE has pumped, yes, more capital in the system, but I wouldn't blame QE for where we are. And I don't mean blame in a negative sense. I mean, it's just where we are is a function of the rise of large asset pools, and that's not a bad thing by any stretch. Yeah. It probably leads to, better overall capital allocation decisions because they're being made more professionally rather than by, a vast number of more amateurs. But it does have that consequence of potentially, certainly in Australia, starving the more junior end of the market of capital.
The other consequence is that there's more money flowing into passive. And you've did some research around how this could potentially also distort markets, especially the public markets, where they come up with all sorts of different flavors of essentially similar indices, but it also then channels potentially funds to particularly a couple of companies that occur often in certain indices and basically get funding on the basis of that rather than of their fundamentals.
Yeah, so I thought like any capital allocation process that's rules-based is prone to some form of danger. So if you just keep following those rules blithely, and remember the whole point of passive was about allocating in a certain way, a market cap weighted sense across the broader economy almost. And it works when you've got very large and diverse equity markets. But gradually, as the proportion that is passive becomes larger and larger, and indeed, in fact, in certain markets like Australia where they're sort of more concentrated, that can have a consequence that it starts to distort, certain companies in the way that they're weighted within the indices. And then I think the rise of passive as a I don't like the word asset class, but where you get a passive exposure to a certain thematic that then overweights the companies with no real bearing on their economic impact, and you just get this weight of money, and then the other passive money comes in and has to allocate more to it because it's got a higher weight, and so you can end up with a disproportionate allocation in certain companies, and you've seen that I think in some of the tech names, and even some of the dividend payers. Whenever a thematic comes through, it gets a lot of money, and then by definition, those companies get pushed up in price and get overvalued.
Yeah. I can remember that at one stage I saw there was a sushi ETF coming out, and I was wondering if that's really a product the world needs. But
yeah, I mean, those are marketing concepts. The idea is that passive was meant to be low cost exposure to a broader group of investments, and I think that's been sort of slightly skewed when you start talking about real flavor of the month passive strategies.
So the other argument for passive investing is that it's simple. It simplifies the investment process, and often when there's too much complexity in a portfolio, it's hard to keep track of it all, and also to basically communicate it to stakeholders. How do you look at complexity? Are we giving up too much by just having passive strategies?
Look, and passive has a very good place in some portfolios, and bear in mind that actually the bigger investors, as we've just talked about, have virtually no choice but to hold passive or quasi-passive exposures. But the point that I would make about passive is that no investor is truly passive. You have money coming in if you're in an accumulation phase. You have money going out if you're in a decumulation phase. So you have to manage the cash flows, and where you allocate capital to and take it from shouldn't be entirely a passive decision. You should have some view on where, what price you're paying for assets. And particularly when you're allocating amongst equities, bonds, property, cash, whatever, you should have some bearing. So you can't be entirely passive, I think, in a total portfolio context. And even where you are, those big passive holders have to take a much more active role in a governance sense. So, to me, passive is just it's a simple way of implementing a certain part of your investment strategy, but it's not your investment strategy. It's just a way of implementing a piece of the investment strategy. And as long as you bear the total portfolio in mind and your objectives and all that kind of stuff, passive has a place to play in that. But it's not the answer to everything.
So you're not concerned about the predictions that I think it is by 2021 we will see more money in passive than in active?
Not at all. And I think, again, I would sort of come back to the point about markets being somewhat cyclical. And I think the passive will rise just because active, probably had proportionately too large a share. But there's a point where passive can't, you can't have 100% passive or the markets don't function. So, and whether that, I don't know whether that number's, 40, 50, 60, whatever. And I kind of almost, it's not that relevant because we'll never get to really high levels just because something will happen that causes a change. So the cyclicality will kick in.
Yeah. Now, you mentioned that cyclicality. Looking at investment styles, value hasn't worked for probably the past decade. What are your thoughts around that? Is that something that is structural or is that cyclical?
Look, you can make an argument for both. I mean, I've seen plenty of arguments about it being structural just because of the way value is defined. And I think, if we think about value in a, sort of book value context or, or in businesses which have, high tangible assets and low intangibles, then certainly there's a change that's taken place in markets where intangibles are now of extreme importance, and so how you define value, I think, has probably changed over the course of that. But value as an investment philosophy is a very sensible strategy. Buy things that are cheap. I mean, it kind of makes intuitive sense, and I don't think that will ever go away. I'd be far more concerned about buy things that are expensive than buying things that are cheap. Yeah, but value's also had it's had long periods where it doesn't work. Again, that's the cyclicality of markets.
Yeah. But it is within these big technology companies where there's so much depending on the IP that arguably it is harder to value what an IP is actually worth and when it's at a discount or not.
So I agree with you. I think that's the issue is the definition of value, and how do you place a value on certain of these organisations is the more difficult thing. But also too, I mean, I think certainly at the moment markets have gotten a bit carried away, and whether it's QE or some of the passive bits that we talked about, or just sort of momentum more generally, encouraging more investors to invest in it. It's it could be a whole combination of things, but it's quite clearly that there are some levels of what I would call exuberance in certain parts of the marketplace. And while that hurts in a value context, value is always going to be, or any investment style hurts the most at its peak. Or at its trough, I should say. When the alternative is at its peak, that's the point of maximum pain.
So do you think that the process of value can be adjusted to reflect the current market conditions, or do you get very quickly to a point where you basically have style drift?
I think I'd be very careful about saying current market conditions, because that I think does infer style drift. I think it's more about making value work for the nature of markets, and recognising that the term of value, and particularly again this rise of intangibles on the balance sheet, requires maybe a bit of a different way of thinking. But I'm sure there's plenty of value managers who've already all over that and captured it, and some of these things probably still look really expensive. So I think again, styles are cyclical, and value and quality in particular. If I had to have a bias in my portfolio, it would be slightly biased to value and quality than I would be certainly to momentum.
So one of the things that you're interested in is more in this private market aspect. Can you tell us a little bit about what you're doing there?
Well, it really comes back to the whole sort of VC space, and how do you encourage better capital formation? And particularly, as I said, in Australia, I think you've got a well-established VC market in the States. Potentially, sort of as the assets have grown in that space, probably managers charging too much for the service, much like sort of what happened, I think, in private equity. But in Australia, we don't have it, and I just think that there's really something that can be done. And where you've got a small number of large asset pools, we really should be looking for ways to allocate capital to that space and try and generate some sort of venture capital ecosystem, albeit without necessarily, I think this is our chance to kind of invent that space without imposing, a more traditional third-party fee model over the top.
Now, one of the activities you do is you're a director of a fintech company. One of them is OpenInvest. What is your interest there in this particular space?
So that was much more specific in the asset management space, and we talked about some of the issues that active asset managers, or just asset managers generally, were facing, and the rise of large asset pools, particularly in Australia, making the institutional market less of a source of funds for them. But at the same time, in the what I'd call sort of the retail and wholesale markets, you've seen this real explosion in SMSFs and so forth. And I would say actually a large amount of professional or non-professionally invested assets. And so the idea behind OpenInvest is to have a simple mechanism through which people can allocate to a diversified portfolio and get a lot of the benefits that come from a more traditional portfolio structure, but build it very cheaply. One of the things that gets me is when I look sort of, all the regulation, other things that have gone on in Australia in the retail marketplace, Royal Commission and so forth. The cost to member hasn't really gone down, and it's like, well, surely we can build things, particularly with technology, that deliver professionally managed portfolios to individuals at a much cheaper cost, and that's the concept behind OpenInvest.
It's an interesting model, because I think it shows what a lot of fintech companies trying to do, in the sense that you have sort of a traditional model where you have a distribution platform, you have the asset manager space, but then there's elements incorporated of social media-like features, so you can like things, you can share things. In essence, what is happening there is that you try to create communities around certain products or services. Is that sort of what interests you, or is it more directly coming from the asset management space?
So the point to me is really about, simple, well-designed portfolios being delivered to the general public in a relatively cheap format. And I think that's, we're great at creating themes and, charging, probably excessive fees for that as an industry to individual consumers, and trying to stir up, momentum around, those particular themes or concepts. Whereas actually what I think we really should be doing, particularly with a more fiduciary type of mindset, is simple, typical balance type portfolios that are well diversified and well structured, and delivering them at a pretty reasonable fee, and that's the concept. And with that, you need to have things like content layers that sort of give you all of the right sort of behavioural impact with your customers and so forth, and deliver the messages out there in the right way. But the real premise is you have to do all that sort of stuff to deliver a simple, well diversified, professionally managed portfolio at a cheap cost.
Yeah, absolutely. But I was also thinking about that struggle for getting people's attention. And it can be very powerful to have something that's just sitting on your phone, and you can talk to other people, and you basically can go there without necessarily having to invest in a fund. You can just check up on it. That must be a very powerful feature.
I think so, yeah. And I mean, clearly that social media more generally is changing the whole way in which consumers interact with each other, the way in which they interact with third parties, and that will continue. People will come up with new ways of delivering content to the end customer. Things like Web 3.0 and things blockchain and so forth could even mean that some platforms are no longer the right delivery mechanism for all sorts of content, because it becomes much more individual to individual. I think what you're seeing is an explosion in the way people want to interact, and definitely, I have to look at my kids. They spend an awful lot of time looking at their phones and interacting through their phones, and it's the norm.
Yes. So you just mentioned the fiduciary side as well, and you've joined the asset owner side as well with TCorp. Can you tell me a little bit about how you came to TCorp and what your role is there?
So I've joined New South Wales Treasury Corporation as a non-executive director. I was lucky enough to get approached by them in my sort of last few months at Schroders, when it was all very public that I was retiring from executive life, and I think it just turned out to be a good fit. I mean, TCorp is a fantastic organisation that's going through some pretty fundamental changes, particularly in the investment model, as a result, of the merger between what was WorkCover, now iCare, State Super, and the original TCorp portfolios, and now it's looking at an asset size in excess of $100 billion, and it needs to be managed in that form. So it's a really exciting time to be there. The team's been built out. It's a great role. So as well as being a non-exec, I'm also chair of the board investment committee. Yeah,
the executive team seem to have a real drive to build us out into a global quality asset management firm, coming from sort of that more sleepy government organization probably, but
I probably wouldn't describe it necessarily as sleepy, but certainly quieter. And the asset size was significantly smaller if you go back 5 years. And I just think that we've seen a pretty fundamental change in their business, all driven by the right sort of economics. And that's a great time to be there and be involved in the transition. There's also, it's a very interesting business, TCorp, because it's also the government's debt issuing authority. So it's got a very large issuance side to the balance sheet as well. So it's a fundamentally different organisation to most asset owners, in that you've got these two fairly large parts to the business.
So it took a while to get your head around all the different moving parts.
I would say some of it you're still getting your head around. You always are, but I think that's the great thing about these sorts of roles and the challenges, and particularly in moving from a third party asset manager to an asset owner. There's you learn new things all the time.
Yeah. So what else is on the agenda for you? So you have directorships. Can we see you at any other roles?
Well, I think in terms of sort of building out a portfolio, you'll see me pop up, I suspect, in one or two other places, in a non-executive or advisory type capacity. As well as that, I've got some personal business interests with the family, which keep us occupied for a little bit of the time. And as I said, that the whole thing we talked about in terms of the venture capital space is something that interests me in terms of helping, build out that ecosystem in Australia. And I think, it's a really exciting time in my career to be involved in a whole range of different things, rather than, sort of singly in one sort of more commercial type arrangement.
Yeah, excellent. Well, Greg, thank you very much for your time. It was good speaking to you.
Thanks, Wouter. It was great.
Thank you for listening to the i3 podcast. For more information, please visit www.i3-invest.com. Thank you very much.